The impossible win. The phone rang at 3:17 a.m. in his London home. On the other end of the line, a trader in Hong Kong, voice crackling with static, almost shouting, "It's working, George! Good God, it's actually working!" George Soros did not smile. He did not celebrate. He simply nodded slowly, gazing out the window of his study as London slept, unaware of the financial earthquake that had just shaken its foundations. On the screen before him, numbers spun with hypnotic speed. 10 million, 50 million, 200 million pounds in profit. And they kept rising. In 24 hours, this man, a Hungarian immigrant who had survived the Nazis and the communists, would do what no one in the history of capitalism ever had: break the Bank of England, not with weapons or armies, but with an idea, a bet, and an amount of money so obscene it made kings' fortunes look like pocket money. And the craziest part? He was playing against the very rules he had helped write. This is the story of how George Soros declared war on the world's most powerful financial institution, won, and in the process, rewrote the manual on how money works. The philosopher who found the flaw in the system. London, 1952. The young man who had been Paul Kiss arrived at the London School of Economics in patched clothes and a heavy accent. While his classmates debated Keynes and Marx, Soros got lost in the halls of philosophy, drawn to a man with explosive ideas, Karl Popper. Popper preached the open society, a world where no idea was sacred, where all truth was subject to testing and refutation. For Soros, it was a revelation. He saw in financial markets the embodiment of the open society, a chaotic, unpredictable laboratory of human belief. But he went beyond Popper. In notebooks he still keeps, he scribbled his own theory of reflexivity. In simple terms, it was this: markets don't reflect reality, they distort it. When investors believe something will happen, their acts of buying and selling make it happen. It's a feedback loop, a self-fulfilling prophecy. Imagine a crowd thinking a bridge will collapse. They run. The unbalanced weight makes the bridge sway. The sway scares them more. They run more, until the bridge actually collapses, not from a structural defect, but from the collective belief that it would fall. Soros saw this phenomenon everywhere, and he realized if you could identify the moment when market belief had detached from reality, you could bet against that belief, and in the process, make a fortune when reality finally settled the score. It was an intellectual weapon of incalculable power, but he needed a battlefield, a target. He found one in 1979 in a Brussels meeting room when European politicians, trying to create a common currency, invented a system so fragile, so full of contradictions, that it was basically an invitation for someone like Soros to test his theory to the limit. They called it the European exchange rate mechanism. Soros would call it his perfect opportunity. The perfect trap: how Europe built its own death trap. Brussels, 1979. European leaders, dreaming of union, created a system to tie their currencies together. The British pound, the German mark, the French franc. All would dance together within a narrow band of fluctuation. It was like tying horses of different temperaments to the same cart. The anchor of the system would be the German mark, the strongest currency after Germany's reunification. The problem was in the rules. If a currency neared the lower limit of the band, that country's central bank had to intervene. It had to spend its reserves to buy its own currency, propping up its value. But what if the country didn't have enough reserves? What if speculators smelling weakness attacked en masse? The system had no answer. It was a promise of infinite defense with finite resources. For a decade, the system worked. But in 1990, German reunification spawned a monster: inflation. The Bundesbank, the German central bank, reacted as it always did. It drastically raised interest rates to cool the economy. For Germany, it made sense. But for the rest of Europe, it was a disaster. Britain, in a deep recession, needed low interest rates to stimulate growth. Yet, to keep the pound within the band required by the European system, it was forced to match high German rates. It was a deadly medicine for a sick patient. The British economy groaned, unemployment rose, companies went bankrupt, and with every Bundesbank announcement, the pressure on the pound increased. In his New York office, Soros watched this contradiction with growing fascination. In his diaries, he noted, "The contradiction between German monetary policy and British needs is unsustainable. The system only holds because markets believe central banks are all-powerful. But what if they stop believing?" He began making discreet phone calls, analyzing the Bank of England's reserves, calculating the cost of defending the pound. The numbers were clear. Britain couldn't hold on. It was a matter of time. In August 1992, a leak to the German newspaper Handelsblatt quoted a Bundesbank official saying a devaluation of the weaker European currencies was inevitable. That was the crack. Soros saw the belief begin to fracture. Reality was about to catch up with fiction, and he prepared to make the biggest bet of his life.
The War Room. Preparing the billion-dollar attack. New York, August 1992. The atmosphere didn't resemble a noisy trading floor, but a silent submarine before an attack. Soros gathered his high command. Stanley Druckenmiller, the chief portfolio manager, cerebral and aggressive, and analysts who looked like wartime codebreakers. No technical charts. Instead, there were IMF reports, Bundesbank minutes, and British political statements. "We're not betting on numbers," Soros explained. "We're betting on the psychology of two men." He pointed to photos. Norman Lamont, the embattled British Chancellor, and Helmut Schlesinger, President of the Bundesbank, rigid as steel. Lamont needs a strong pound to save his career. Schlesinger can't cut rates without reigniting German inflation. Both are trapped. The strategy was simple and colossal. Short the British pound. Borrow pounds, sell them for Deutsche Marks, and buy them back cheaper after the fall. Pure profit. The risk was devastating if the pound held. Even so, Soros chose to attack. He ordered a $10 billion credit line with major banks. Heavy leverage. Druckenmiller suggested starting with $3 billion. Soros replied, "That's nonsense. If you're convinced, bet $10 billion, all or nothing." The selling would begin quietly. The blow would come with a public trigger, a speech by Schlesinger. On September 15, 1992, he spoke of realignment in exchange rates. For Soros, it was the signal. Germany would not defend the pound to the end. The submarine fired. Black Wednesday, September 16, 1992. London woke under a leaden sky. At the Treasury, Norman Lamont was exhausted. Screens showed constant selling of the pound. At 8 a.m., the Bank of England intervened, buying pounds with reserves. 1 billion, then another. The pressure eased slightly. In New York, 3 a.m., Soros watched it all. Seeing the intervention, he called Druckenmiller. "Now, increase the selling." Hedge funds began dumping pounds by the billions. Banks panicked. The tide turned into a tsunami. At 11 a.m., Lamont raised interest rates from 10% to 12%. Desperation. The market laughed. The message was clear. Reserves were bleeding. At 2:15 p.m., another hike to 15%. Final theater. The bluff was exposed. Reserves ran out. The pound collapsed. On the quantum fund screens, Profits spun. $100 million. $500. $800 million. No celebration, just execution. Buy back cheap pounds, close positions. At 7 p.m., Lamont announced the UK's withdrawal from the European exchange rate mechanism. Surrender. That day, Soros made about $1 billion. The UK lost £3.3 billion in reserves. The next day's headline read, "The man who broke the Bank of England." Soros slept. Not like a conqueror, but like someone who had just proven his theory. Reality is reflexive. The price of victory. The global anti-hero. The next day, Soros woke up famous and infamous. To the British, a financial vampire. Cartoons depicted him as a global octopus. Politicians railed against stateless speculators. Elsewhere, however, there was quiet admiration. He had exposed a flawed system. Soros gave interviews. "I didn't attack the pound. British policy attacked the pound. I merely exploited the weakness." Even so, he became the symbol of globalization's fear. Borderless capital capable of toppling governments. His past as a Holocaust survivor was used against him. The paradox was cruel. The man who fled totalitarianism was now seen as an impersonal, destructive force. Worse, Black Wednesday taught the world that central banks could be defeated. Crises followed in Mexico, Asia, Russia. Millions suffered. Soros shifted from philosopher investor to the archetype of the global villain. Then he did the unexpected. He began spending his fortune trying to fix the world. Foundations, education, health, open societies. More than $32 billion donated. Remorse, legacy, or reflexivity applied to society? The question remained: prophet or predator? The world Soros created. 30 years later, Black Wednesday still echoes. It killed blind faith in central banks and accelerated the birth of the euro, created to avoid crises like that one. Did it work? Or did it merely create a bigger target? European Union tensions repeat. On a continental scale, the conflict of 1992. Reflexivity became dogma. Today, markets talk about narratives and sentiment. Cryptocurrencies are the ultimate example. Value sustained by collective belief. Soros remains polarizing. To the right, a globalist conspirator. To the left, a symbol of financial inequality. But the central lesson isn't about money. It's about ideas. One man identified a flaw in the global system and exposed it to the world. He showed that behind the numbers lies psychology. And he left an uncomfortable question. If you saw the flaw, as he did, and could make $1 billion in a single day, would you? Markets don't move on scruples. They move on opportunities. And as long as systems exist, there will be flaws, and someone ready to exploit them. Reality is negotiable. Reality is negotiable. Systems are fragile. Sometimes, all that holds them together is collective belief, an invisible consensus that, once broken, can cause entire structures to collapse. George Soros did not create this truth. He merely revealed it, understood its mechanics, and chose to exploit it at the exact right moment. Black Wednesday made one thing clear. Behind charts, policies, and official statements lies something far more powerful: human psychology. And when confidence disappears, even the largest systems struggle to remain standing. If you enjoyed this journey through one of the greatest financial feats in history, subscribe to the channel and leave a like. It helps bring more stories about empires, collapses, and minds that dared to challenge the impossible, and, in doing so, change the course of the world. See you next time.